Welcome to Volatility Trading Strategies. So we're in the heart of another fairly significant market decline here. The S&P 500 has dropped 6% in the last 4 trading sessions. And actually that takes it down to the same level it was at in January of 2018. On a buy and hold basis, the S&P 500 hasn't gone anywhere in over 18 months. Now that in itself should be a red flag for anyone who is a buy and hold investor, but moving on. The VIX index, a very popular volatility index, oftentimes called the fear index, spiked 39.64%, making yesterday the 15th largest spike in its history going back to 1990. And the VXX, one of the largest of the volatility ETFs, spiked 14.19%, which was the 22nd largest spike in its history. Now, on a side note, while I do have this chart pulled up, because it is important for traders to always keep this in mind, all of the volatility ETPs, not just VXX, are risky products and should only be navigated by those who understand them. And more importantly, those who understand how to mitigate the risks involved with trading them. They are not to be toyed with. Let's not forget we lost the XIV last year in a single-day kill shot during the February Volpocalypse event. So trying to time these products should always be done cautiously, with much smaller amounts of overall capital. Now, with that disclaimer out of the way, we can proceed. So what we're seeing this past week isn't the largest market crash we've seen in recent years, not yet anyway, but it's significant enough that we can start asking the question, how can we tell when the selling might be over? Because I do specialize in trading volatility, whenever we see these volatility spikes with the VIX up nearly 40% in a day, I do always get a bunch of emails and DMs asking me that question. When can we start shorting volatility again? Let's discuss that. I'll crop the name out, and hopefully this gentleman doesn't mind that I'm using his question, but in times like this, I do get a lot of these. What quantifiable measures or information indicate a VXX spike is likely maxed out in magnitude or duration? So thank you very much for the question. Now, before I answer it, let me just go into round 2 of the disclaimers here, because I am a systematic trader that uses quantifiable metrics to guide my trading decisions. I'm entirely mechanical with my ETF rotation strategies. I track a multitude of metrics, and I use all of those to guide my investing decisions. When the math supports a trade, I take it, and when it doesn't, I don't. That's what it means to be quant-based. We spend a lot of time analyzing data in order to reduce the uncertainties and improve our performance. I've had a lot of success over the years after eliminating personal market predictions about what may or may not happen. I just stick to the math, and it's worked out well for me. If you want to learn more about my style of navigating the markets, feel free to poke around my website. There's a lot of useful articles and videos on there about these metrics I pay attention to that you may not find anywhere else, so check those out when you have some time. So I, for one, won't be trying to time when the VXX has maxed out based on my feelings or personal market predictions. I feel like that's a low probability way to trade, and results are mixed. However, I am a realist, and I understand that not everybody's going to agree with me here. And there's certainly going to be people out there who are trying to bottom fish for those short vol entries, whether I think it's a good idea or not. So I thought I would start a new series here, just highlighting a few of the things that people can keep an eye on that might make some of that bottom fishing / knife catching a little bit more successful. Today will be part 1, and I'll build on this series as more market crashes sneak up on us. 10 years into the longest bull market in history now, and the Fed cutting rates for the first time in years, trade war possibly heating up, I feel like I'm going to get some opportunities to add to this series. So one metric we can look at is the S&P 500 put-call ratio. Here's a chart of that for the past 10 years. Now, without boring you too much, this is a simple metric that measures the ratio of put options to call options on the S&P 500. If put options have higher volume than calls, then the put-to-call ratio would be greater than 1. If there's more calls than puts, the put-call ratio would be less than 1. And for a metric like this, only extreme readings on either side are valuable. There's a whole bunch of noise in the middle there that can just be ignored. But this chart is really messy, so let's look at a chart just since January of 2018. Now we can see a chart with a few extreme readings. And I just want to show you what the S&P 500 was doing at those specific moments when the S&P put-call ratio became elevated. The first extreme point, March 23, 2018, the put-call ratio hit 1.54. Here's the S&P 500 over the same time period. And that corresponds to the point right here. There was some whipsaw for a few days after, but it was more or less when the markets decided to bounce and go up again. The next extreme reading came on December 20th, 2018 when it hit 1.82. Recall the S&P 500 crashed minus 20% in the fourth quarter of 2018, the largest decline since the financial crisis. And December 20th saw an extreme skew to the put-call ratio. December 20th is right there, and a strong recovery started a few days later. I'm not saying it's because of this, but we are just trying to gather some data points. Extreme point number 3, May 29th, 2019. The S&P 500 put-call ratio hit 1.41, the third highest value in the last 2 years. Where's May 29th, 2019 on the S&P 500? Right there. And a few days later, the ugliness we saw recently in May 2019 subsided and markets shot up again. Well, here we are, August 2019. Markets are down minus 6% in a few trading sessions. The VIX saw its 15th largest spike. And once again, we're seeing an outlier in the S&P put-call ratio. As of market close on August 5th, it reached 1.24. Not as high as the other readings just yet, but clearly well above the normal. It actually doesn't get this high very often. I'm sure you've heard it said before that markets bounce once we see capitulation. Essentially, that's a way of saying that the majority of people have just thrown up their hands and given in. Either sold enough of their miserable tanking stocks, or scrambled and bought enough S&P 500 put options to hedge. That's capitulation. And from there, the markets can start to build, or so the theory goes. Well, the S&P put-call ratio is just a way to possibly quantify that capitulation, beyond just a feeling or a guess. So does that mean with an elevated S&P put-call ratio right now that the markets are going to bounce soon and we should be shorting volatility with both hands? No, in my opinion, that's not how data should be used. This is just one metric, but it is something to keep an eye on if you were the contrarian type that is looking for a point to jump in. If you have several metrics and all of them agree, then at that point it could be considered a good risk-reward trade. One metric on its own can't do that, but 3 or 4 working together could. Just remember, and this is the third disclaimer in this video, volatility often begets more volatility. And whenever we see a VIX spike to 25 in a few short sessions and a major technical break in the market, it's a very short trip to a VIX of 40 or more after that. I can't tell you how many times I've seen volatility traders head back in after the first wave clears, only to be hit with another one right afterwards. VXX, TVIX, UVXY, these volatility products do have waves. So I don't play the knife-catching game, but it's my intention with this video series to give you a list of metrics that you can use just in case you are the type that wants to give it a shot. And the S&P put-call ratio is definitely something you want to keep an eye on. So there's going to be many more in this series. Stay tuned for all of those in the future. Thanks for watching. Thank you so much for watching the video. So don't forget to subscribe to the channel and go check out my website right here. There's tons of articles and videos on there, as well as a free trial to join the VTS investing community. What have you got to lose? Come see how I personally navigate these unruly markets. See you next time.